Why does it seem like some loans never go away? Well, there's lots of reasons. Ted Michalos is here to discuss it, starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. So, has this ever happened? You're meeting with a client, someone who's got a bunch of debt, and you say to them, so how long have you had this debt? And they say, oh man, I've had it for like years and years and years. Has that ever happened to you?
Just about every time we talk to somebody.
All the time.
Yep.
So why is that? That's what we're going to talk about today. Why is the system apparently rigged against borrowers? I think that's kind of obvious. But before we do, let's get some definitions out of the way just so we're all on the same page. So I got 5 quick terms. Tell me what they mean. Number 1, principal.
That's the amount of money you're actually borrowing. So if you go in for a loan for $10,000, the principal is $10,000.
That's how much I got.
Yep.
Okay, now people get confused between term and amortization. So what is the term of a loan?
So the term of the loan is its duration. How long is it going to run? So it could be 1 year, 12 months, 2 years, 3 years, 4 years, 5 years, or forever.
And so, as we're going to talk about. And so at the end of the term, the loan is paid off.
Correct.
What is amortization period?
So amortization is the frequency with which interest is going to be charged and the debt is going to be reduced. So the term tells you how long you're making payments. The amortization tells you how the payments are going to be made, if that makes any sense.
Well, and the most common example, like a car loan, the term and the amortization are the same.
Yep.
In a mortgage, they're not.
Right. So in Canada, in particular, mortgages, let's say you get one for 5 years. So the term of the loan is 5 years. The amortization for the loan is probably 25 years. And so you're only paying interest for the 5 years of the contract. That's the term. But they figured it out or calculated it over the life of what they expect the loan to be.
So at the end of the first 5 years, I still owe money.
Probably another 20 years.
Right, another 20 years, in which case we renegotiate, the interest rate gets reset, and so on. So amortization is different than term. Okay.
Right.
So again, this is a pretty simple question, but what's the difference between, and again, let's talk about either car loans or mortgages, interest payment versus the principal payment.
All right. Well, so if you know how much you borrowed, so remember that was we're calling it the principal. You borrowed $10,000. Anytime you pay back part of that original amount, you're paying back principal. So you're reducing the amount of the actual loan. Any other money you're paying is the cost of borrowing, is interest.
And so if I have a 25-year mortgage, the amortization period is 25 years, and if the first month my payment is $2,000, how much of that is interest and how much is principal?
Yeah, probably $1,800 is interest, and if you're lucky, $200 is principal.
Yeah, and it might even be more than that. So
at
the start of the long amortization period, everything you're paying is interest. You're not not everything, but virtually everything.
Even with car loans. So let's say you've got a 5-year car loan. The first 2.5 years, you're probably, the interest is more significant than the principal.
Yeah, so and that's why people come in to see us and they go, well, I've had this car loan for a year and I still owe almost the same.
Right. And my car's worth half of what I owe.
Yeah. So this is a problem.
That's a different issue.
So what then is compound interest?
So compound interest is probably the single most evil creation ever in the world.
Ooh.
This is you're paying interest on your interest. So let's say I borrowed money from someone, I don't know, who do I hate the most? A payday lender. So they lend me money and they say, you're going to pay 10% interest, and I'm not able to pay it back. And so now the loan is 110% of what it was, and I'm paying interest on 110% instead of the loan itself.
Well, and I guess maybe a payday loan's a bad example because in theory you pay it off in 2 weeks, but a credit card.
Yeah, actually, those are probably the worst examples.
A credit card has, in effect, interest on interest, right?
Well, and, you want a good example, recent history, all these deferrals that have gone through from CERB, you're paying interest on the interest.
From COVID.
Yep.
Yeah. Yeah. So that's right. So the loan was this much. They tacked the interest on, and now I'm paying interest on interest.
That's right.
And that's what compounding is. Okay.
And it just keeps getting worse and worse and worse. Chip mortgages. I hate these bloody things. Interest on the interest.
So these are reverse mortgages where you're just paying interest on interest. Right. So compounding is great if I have money.
If I'm receiving the compounding, it's the key to getting rich.
It's wonderful. I've got money in my bank account that is earning interest, and then I keep earning interest on the interest, and it keeps growing. My RSP keeps growing, whatever. But if I'm paying it, it's the other way around. Okay, so we got the definition out of the way. Back to today's topic. let's get focused here.
Right.
Why do some loans seem to last forever? Why is the game rigged so the borrower always loses? So let's start with the most common one where people have had the loan for many years and they still owe as much as they borrowed. That would be a line of credit. So what is different about a line of credit than a regular term loan?
Right. So a term loan has very specific repayment requirements, and you're going to pay back the interest and part of the principal every month or every period that you make payments, and eventually the loan gets worked down to zero.
And that's why they call it a term loan.
Right.
There's a term to it.
A line of credit is, I've allowed you to have access to this much credit, and what you've got to pay every month is the interest on it, so the amount of money that you borrowed. Now, most companies also require you to pay a portion of the principal, but you can immediately take it out again. So, for example, I don't know, if you got a $10,000 line of credit, your minimum payment every month is probably, I don't know, $85 or something. But once you've paid that $85, you still owe the $10,000. And so the loan hasn't gone down at all. The line of credit balance is still the same. You've just given them that money for the right of using their money.
Yeah, and there are some lines of credit where the rules are, well, you just pay the interest.
Right. Well, and again, all lines of credit, even if they bill you for the principal, you could turn around the next day and take that principal right back out again as long as you're in good standing.
And so the reason that a line of credit can last forever is you're only paying the interest on it.
Right.
You're never paying the principal back if you never pay the principal. And a line of credit could be an unsecured line of credit, or it could be a HELOC, which is a line of credit secured against your home. So what about small payment loans? So talk to me about, car loans and they're 8 years now, apparently.
Yeah,
in some
that just
cases.
drives. I mean, my initial reaction to 8-year car loans was it's insane because the car won't last that long. But actually, modern manufacturing techniques, they do last that long, so it's not as bad as it seems. It's just the interest is horrendous. The longer the term of the loan or the longer the period of amortization, the more interest you're going to pay.
It's as simple as that,
Right, because you're paying longer.
Yeah, interest is the rate you're paying, but it's also the time that you're paying it.
Right.
So, what about these 0% financing loans then? So, and again, cars would be a classic example. They want me to buy the car. Where's the trap there? That sounds pretty good to me. 0%. What's the problem?
Well, so for things like a furniture loan, the trap is at the end of that 12-month interest-free period, if you don't pay at all, interest is retroactively put back on. So that's the trap with them. But with any company that's offering you 0% interest, the cost of financing is built into the cost of the purchase. So if you go in to buy a car and it's 0% financing for 5 years and you say, well, I can pay cash, you can get the car for probably 5-7% cheaper because you're paying them cash.
Yeah, and that is almost always true, except there are cases where the car company, the retailer, is getting some kind of, I don't want to call it a kickback.
Some kind of financing
promotion. Financing fee or something. So they actually want you to finance it because then the financing company is kicking the money back.
Right. Well, and dealerships make more money off the financing than they do off the margins on new cars.
Yeah, they don't really make money off cars. They make money off the financing,
servicing and the financing and all that ancillaries.
So let's go back to lines of credit for a minute. So they're a trap because, and the reason they last so long is because you're only paying the interest.
Right.
But, and I think you kind of alluded to this before, where else are they a trap then if it's not just the interest?
So the biggest trap of a line of credit is you've been pre-approved for this amount of money. And so let's say things go great and you pay it down, you can immediately take it out again. So you could pay off the debt. You still have that line of credit. If you haven't canceled it, you've got that $10,000 waiting there for you to use again. And just about everybody will use it again. And so instead of canceling it, getting rid of it, you keep it there and you use it. Like, it's smarter to put purchases on a line of credit than a credit card. The interest rate is lower. What we find most people do is they run up the credit card, they get a line of credit, pay off the credit card, run it up again. Now they've got the line of credit and the credit card. I mean, it's just insane.
Yeah, and we're not saying that this is some, evil thing or horribly irresponsible thing.
Sure we are. It's a horribly evil thing. It's the bank's got you.
Well, on the bank's point of view, sure. Yep. I mean, from the person's point of view, it all kind of makes sense, though. Like you said, I mean, okay, I need the money, I use it, and I have every intention to pay it back. But then, COVID strikes and I lose my job and there's problems and it's still there. So, okay, so let's go back then to see if we can understand it. I don't know if you can explain this in simple terms or not, but so why is it then when I have a term loan, the interest is so much front loaded then. So you gave the example of, well, my payment is, $500 every month on my car loan. The first year of my 8-year car loan, almost all of that $500 is interest. Why is that? Why isn't it evenly spaced out throughout the loan?
Well, because the way compounding works and interest charges are, you've got a loan, and in the first 30 days, you've borrowed that full $10,000 for the 30 days. And so you owe interest on using it for 30 days. So if your payment is set at $500, almost all of your payment goes to paying that interest expense. So the second month, you've paid a little bit off the principal. I don't know, let's say $50 just to make up a number. So now in the second month, you owe $9,950. So again, almost all of your payment's going to go for the interest charges for that month. And it just keeps working that way until you get about 2/3 of the way through the loan. At that point, you're paying down the loan very quickly because the interest charges have become less significant. But the first 2 years of car loans or any other kind of loans, you're paying interest, interest, and interest.
And the last month of the loan, well, it ends up being pretty much all principal.
Right. Because by the final month of the loan, you probably only owe $400 on the car.
Yeah. So
right, even less, right?
The interest on $400 is tiny.
Yeah.
So what happens then if I've got an 8-year car loan and I decide a year into it, you know what, I can't keep the car anymore.
Yeah.
I'm going to give it back.
So now you're talking about negative equity in the car and rolling debts over. And so many people do this. So I've got a car. I trade it in any time before the value of the car exceeds the value of the loan. So anytime for the first 3 or 4 years, if you've borrowed to buy this thing, you owe more than the thing is worth. That's the way it works these days. And so if you trade it in for a new car and let's say you do it 2 years into a contract, you actually owe more than the car is worth. And so when you get the new car, you've got the loan for the car plus whatever the shortfall was on the last car. And it's often thousands of dollars.
And so what gives rise to that shortfall then? So I bought the car for $20,000.
Yep.
But I had to finance more than $20,000 because there's tax on it.
Tax and service fees and all sorts of other stuff. So, but let's keep it clean. Let's say you financed it for $20,000.
And so the first month after I've bought it, and if I decide to give it back at that point, that car is worth
80% of
less than $20,000.
That's right.
So I've lost on the car as well as I've got all the interest front loaded. So okay, let's go back to this whole rollover concept. You race cars. Talk to me about rollovers. What's a rollover?
It's a different kind of rollover. I had one of those once.
Oh, I'm sure.
Interesting experience.
We got to get some video of that.
But so rollover with car loans, or even, to some extent they do it with other loans, but it's whatever you still owed on the loan, it doesn't matter. They simply take the shortfall from what they get for the car on a trade-in and they add it to your new loan. And so the example we were just talking about, this $20,000 car, at the end of the first year's depreciation, it's worth $16,000. Let's say you trade it in month 3 for whatever reason. Well, so now you're $4,000 short on the loan, and they'll just add it to the next one. And so you buy another car at $20,000, you're starting at $24,000. So you're already behind the 8 ball because the loan's always going to be worth more than the car ever was before you even started.
And because interest is front loaded.
Right. You're now paying interest on that $4,000 shortfall from the last loan. So there's going to be, it's not quite as bad as compounding interest on the interest, but you're paying for something you haven't got anymore.
It's pretty bad.
Yep.
Well, and in my experience, and you and I have been doing this for a few decades, we started when we were 10. If someone comes in to go bankrupt or file a consumer proposal and they say, you know what, I don't need my car anymore. I got to get rid of it. I'm working from home now. I can take the bus. It's way cheaper. I want to get rid of it.
Yep.
So we say, okay, no problem. You surrender the car. Whatever the shortfall is will be included in your bankruptcy or consumer proposal. In my experience, in almost every case, the shortfall is $10,000.
That's right.
And it doesn't matter what kind of car it was. It doesn't matter how long you've had the loan for. It's always $10,000. Now, not always right to the penny, but why is that? Why is it always $10,000?
Because almost every car that you get, no matter what they all seem to work out to somewhere between $25,000 and $30,000 to get it off the lot. And by the end of the first year, they're worth somewhere between $15,000 and $17,000. And so you're already $7,000 or $8,000 down in the first bid. And if you've missed any payments or you've had any kind of service incidents, if somebody's dinged you in the parking lot, it just dings some more off of that. Plus, they're going to charge you penalties and admin charges on not paying out the first one to term. So they'll hit you with extra fees and charges because your contract says they can do that.
Yeah, and this is a discussion we have with every single person who comes in to see us who has a car loan. And we say, well, you got two choices. You can actually keep the car and keep paying the loan while you're in your proposal or your bankruptcy. But once you agree to keep paying for it, a month or two into your bankruptcy or your proposal, you can't decide, okay, now I'm giving it back because you've, in effect, re-upped on the loan. So you got to make the decision up front whether you're keeping it or not.
The classic example is somebody that buys more car than they can handle. And so once you've done this rollover more than once, you're way behind the eight ball. So I don't know, a good example these days is a pickup truck at $50,000, $60,000 because it's depreciated down to $40,000. If you rolled it over from one loan to another, you've got a $40,000 truck that you owe $75,000 on. It just doesn't make any sense.
And if you've done that 2 or 3 times, then it can keep. I mean, at some point they're not going to do the loan anymore, but it keeps going.
As long as you've been paying, they'll keep. I mean, it's so easy to get car loans now.
Yep, it's that's a whole nother show.
Because that's how they make all their money. The financing.
Now let's go to your favorite topic.
My favorite topic.
We've been going for 20 minutes here and haven't hit it, so let's do that. Payday loans.
Oh, yeah, talk about these.
I know. So why is it that they never go away? Because conceptually, it's pretty simple. I go and I borrow $500. I'm going to pay it back on my next payday. Why is it that when someone comes in to see us that has a payday loan, they don't just have one, they have more than 3?
Right.
What's going on here?
Well, so, I mean, you kind of hit it on the head there. So a payday loan is you borrow it and 2 weeks later you pay it off. But the underlying issue in the first place was you had no cash. So you were short money. So you borrowed the payday loan to get your money to pay for something. 2 weeks later, you pay off that payday loan. You're still short the money. In fact, now you're short more money because of the charges they hit you with. And so you got no choice but to take out another payday loan. So they're different loans. So legally, you're right. You're paying off the loan, your next one, but they're not. You never get out from debt for one of these things. And once you get multiple payday loans, you are really screwed.
Yeah. And in Ontario, the maximum a lender could charge on a payday loan is $15 on every 100 borrowed. So if I borrow $100, 2 weeks from now, I have to pay back $115. And if I didn't have the $100 to begin with, I don't have the $115 now.
Right.
So I have to go get a second payday loan from a different place for $115, and that's where the cycle goes. And I know the payday loan industry will disagree with what I'm about to say, but in my head, if I get a $100 loan, pay it back in 2 weeks, and keep doing that 26 times during the year, I will have at most only ever borrowed $100, but I will have paid 15 times 26, $390 in interest.
Right.
That to me is a 390% interest loan.
Correct.
Payday loan people disagree. They say, no, it's $15 on 100.
Right.
Now, that on the surface doesn't sound that bad. 15 on 100, that sounds like 15%. I just explained that it's actually 390%, depending on how often you repay. How does that compare with a high interest credit card?
All right, well, so let's pick a credit card at what, 21% interest? Does that sound reasonable to you? The same $100, the interest in 2 weeks on that $100 on the credit card would be 81 cents.
81 cents. And I hope everyone fact checks us on there to see if we did our math right.
$15, 81 cents.
And credit cards are very high interest.
Ridiculously high interest. You should try and pay off your credit card every month if you can.
Yeah, because $100 borrowed on a mortgage over 2 weeks is almost nothing. It would be a few cents, depending on what the interest rate is. So I think that's the key point we want to drive home here, is that interest is an absolute killer. So let's get into practical advice then.
Right.
What are the questions you should be asking before you sign on the dotted line for a loan? Either questions you should be asking yourself or questions you should be asking your lender.
So it's required by law that they disclose to you the total cost of borrowing. But most people never look at that line. And so always ask, how much is it going to cost me to use your money to make this purchase or to borrow, whatever it is you're doing, right? So what's the total cost of borrowing? So it's not just, can I afford the monthly payment? It's, how much is it going to cost me to use these other people's money for what I'm trying to do?
And that's a key point, because in most cases, what we focus on is the monthly payment.
Right. And they encourage you to do that, right? It's all about cash flow. Can you afford the monthly payment? Sure. Can you? Oh, look, it's biweekly. It's only half what you'd think.
And that's an even more of a killer. So yeah, $200 biweekly, I can do that. No problem. Yep. That's easy. Okay, but the total I'm going to pay is the $200 times all the payments.
Times all those
And so on an 8-year car loan where I bought a $20,000 car, I'm not paying $20,000. I'm paying, I don't know, could be 40.
It'll be a big number.
It'll be a big number. Okay, so question number 1, what is the total I'll pay? In other words, what's the principal? That's obvious. That's what I'm borrowing, but adding in the interest and all the other charges. What other questions should you be focusing on?
How long is it going to take to pay it off? And so that's a difficult question if you're using a line of credit because you're in control of how long it does. But on a loan, it's pretty straightforward. Is this a 1 year, 2 year, 3 years, 5 years, 8 years on a car?
And that assumes I don't miss a payment.
Right.
So,
and you don't roll it over into the next one or anything else. This is, I'm going to start the loan and finish the loan. How long is it for?
And so then the final question you'd want to ask would be, okay, what happens if I miss a payment then?
Right.
And what typically happens if I miss a payment?
Well, and so if you arrange for it ahead of time, they've got provisions in most contracts. You can call in and say, I want to skip this month. Okay, they're going to charge you an extra month's interest. Depending on how early you are on the loan, that can be more money than you realize, but it's not a big deal. If you don't arrange for it ahead of time, they're going to hit you with administrative fees, NSF charges. They'll probably ding you on your credit report. I mean, there are all sorts of consequences for missing payments. And if you make a habit of it, the interest costs of borrowing are going to get significantly higher. They penalize you because you're having a hard time paying.
And there's probably service charges as well, and late payment fees, NFS fees, and that sort of thing. So you might have a low interest loan
that suddenly gets very expensive.
Yeah, that suddenly gets very expensive.
Yep.
So really it comes down to understanding how it all works and making sure you're being proactive up front to figure out what the answer is.
I mean, the easiest way to think about interest is it's the cost of using somebody else's money. So how much are they going to charge you for using their money? And then you got to figure out how much are you willing to pay. Most people just look at the payment and say, I can afford that. And you don't look at what the total cost is. And if you, for a lot of people we see, if you look at what the interest is costing, you're just going to start crying.
Yeah.
It's just, you'll break down.
It's a huge number. And the killer is combining interest with time.
Yep.
So a really high interest payday loan, well, if you pay it off in 2 weeks, okay, it cost you 15 on 100. As a percentage, that's a huge number, but it's not the killer.
$15.
It's $15. But if you've got a loan, even with a lower interest rate that lasts for years and years and years, it becomes a big problem. Higher interest over a short period of time, not a big deal. Lower interest, but for a very long loan, lots of interest, well, it does become a big deal. So since you can't control the interest rate, that's not up to you, that's up to the bank, your goal then is to shorten the time. So what are your ideas on how to shorten that piece of the equation? Okay. How can I shorten the time?
Well, so the best way to shorten the time is to reduce the amount you actually have to borrow, which means savings a down payment. So if you go into and you've got no money down, you are paying interest for the whole price of that thing that you're acquiring. Whereas if you got 10, 20, 25% to put down, you're borrowing that much less. And it's a significant difference. Don't take out a loan that you can't afford to repay. So think this through. If it looks like they break it down to biweekly, yeah, you can do $200 every 2 weeks, but what happens if something goes wrong? How tight is that actually leaving your budget? Most people just intuitively say, oh, I can afford that because it sounds like a small number. Do the math. Make sure you can actually afford your payments. And what happens if something big goes wrong? You lose your job, you get sick, your company gets sold to some plant in Asia and you're closed. I mean, how are you going to deal with it then?
Yeah, and I think risk is something that we haven't, well, I think having come through 2020, the year of the virus, it's something we're much more in tune with perhaps than we have been before. What if something goes wrong? What if something does change? So, losing my job is the obvious one.
Yep.
Being in lockdown, being shut down. What is the risk that if something even a little bit goes wrong, I won't be able to make this payment?
Well, and most people don't plan for something to go wrong. That's one of the problems we have in our culture these days. You want it today and you're willing to make a payment. It's not, you don't make a plan for what you got to do. So things go horribly wrong. Well, it doesn't even have to be horribly. If things are going wrong, try to get some help. Talk to somebody who specializes in doing this kind of work.
And so if you are too late, I got the loan and, I thought everything was going to be fine, but I lost my job, I got sick, I got divorced, something happened, then what is the thought process? What's the next step at that point?
Right. Well, so it's all about cash flow. What can you afford?
This
What's
is really
important?
choking you up just thinking about this.
I don't know what's wrong here. Something about a bug or a frog.
Yeah, there you go.
So you've got to look at options. And again, most people don't know what those options are. Can you refinance or restructure the debt that you have? Is there a way to get a line of credit to pay off all these high-interest credit cards and then focus on paying down that? Most people, when we say it's too late, they're no longer have access to that kind of borrowing. So should you be looking at something called a consumer proposal? It's a procedure whereby you repay part of what you owe. Are things really horrible? Maybe you need to look at personal bankruptcy. These are all things that you need to inform yourself so you can make the correct decision. Don't be afraid of the terms just because what you think you know about them. You probably don't know the truth. And oftentimes, if things have gotten really bad, well, you need a serious solution to solve the problem.
And that's exactly why we wanted to do this show today, to explain that there are some traps that you may not be aware of. And I think everyone intuitively understands, well, yeah, high interest is a problem, but okay, it's not just the high interest, it's combining with time that gets into the situation. And so, yeah, look at options to deal with it on your own. If you can, fantastic. If you've still got good credit and can do a rollover, not in the vehicle sense, but in the sense of taking a low interest line of credit and using that money to pay off a credit card, great. But if not, you want to talk to a professional. I was reviewing a file from a lady this morning who's going to be filing a consumer proposal this week with us. She had first talked to us a number of years ago.
Yep.
And she thought she was going to be able to work it out. She actually, things did get better, but then with COVID and everything, things have gotten worse. Debt problems don't get better over time. And as we talked about with compounding interest, it's working against you if you owe money. So you're probably better off to reach out for help sooner rather than later.
Exactly.
Excellent. Ted, thank you very much for being here. Sorry we choked you up so much on that, but I think you'll...
It's a damn payday loans. They do it every time.
I know. And there's another kind of borrowing strategy out there that we're going to talk about on a future show, so stay tuned for that. So the problem is not just interest, it's interest and time. If you can shorten the time, as Ted explained, bigger down payments, borrow less, then you shorten the interest and you end up saving money. So if you can focus on that, then all the better. That is our show for today. Thanks for listening. Until next week, for Ted Michalos, I'm Doug Hoyes. That was Debt Free in 30.